Welcome back. You're watching Markets Today only on Metropol TV, where we look at the performance of the financial markets and provide you with an in-depth analysis of the movements in the local and international capital markets and, of course, the views behind the news. We have in studio with us today Martin Kirimi, Senior Associate Research at the Standard Investment Bank, who are also our partners on Markets Today on Mondays. So we're looking at the weekly wrap of markets last week. Thank you so much for joining us in studio today. Now, first of all, let's have a quick look at the performance of the exchange last week. All the benchmark indices were on a positive note. Well, at least the old share and the NSE 25. However, the NSE 20 seemed to maintain a downward trend. However, today we've seen it spike up slightly. Which of the three barometers are you usually quite keen on, and ideally looking at the 25, where most people seem to be focusing on, because it's the carrier, the basket that has the best stocks in the markets? Which of the three are you looking at keenly?
NSE. Always check the NSE, because the NSE will give the direction of the market. It's market weighted vis-a-vis the others that are price weighted. You're talking about the NSE 20. The NSE 20, in case one of the large caps takes a hit, takes a nosedive a bit, it will affect the whole NSE 25, NSE 20. So the best barometer to check the market performance is the NSE. So the NSE is already up 3%, north of 3%. But May has been quite tough on the market. You've seen quite a lot of large caps taking a hit on, taking a hit from investors. That is your bank stocks especially, and also Safaricom. So from January to April, the market was already up 12%. But you can see the erosion over the last 3-4 weeks. You're talking about an erosion of around 7, 8, 9%. Yes, so the NAS is what investors usually check as a barometer most of the time. Yes.
All right. So foreign participation as well seemed to have reduced last week. Participation in equity turnover, decreased trading of equity bank. What do you think informed this particular move by the foreign investors? On
average, in foreign investors, like you correctly pointed out, the usually average participation is around 60, north of 60%, 55, 60%. Last week, we noticed quite an activity on an increased activity on local investors. So when the locals are actually participating more, you'll notice the shrinkage of participation tilted towards the locals vis-a-vis the foreigners. They still edged higher, but the locals came up to the market vis-a-vis in comparison to the previous week. Yes.
What are your expectations, though? Because traditionally our market is a foreign buyers market.
Yeah.
How do you see the outlook, going forward?
Foreign traders market. Let me use the foreign traders market. What's my expectation going forward? If the global fears that are currently being whispered around come to fruition, we should expect an unfortunate hit on our market, because it's foreign denominated, foreign tilted towards foreign participation. So we should expect that coming to our local market. The same case, actually, just jumping forward, you'll see like today's participation was only, turnover was mere 86 million shillings. That's $900,000. Pretty minuscule by our standards. So we attribute that to the current, today there are 2 public holidays in the US and UK. So foreigners being on holiday, that shows you how big of an impact that has on our local market. Yes.
If I can just push slightly on that, when do you think Kenya's capital markets or the financial markets will fully recover, from the hits that happened last week with the mass exits of some foreign traders? Because as we've said, last week, for instance, we saw equity turnover from foreign investors at 53%. What do you think will excite the markets going forward, given what's happening both in the global space and the local space?
That's a very good question. What's this trigger? Because that's a question you get from investors severally. What's this trigger that all of a sudden we'll have to see, we'll get quite activity in our market, and bullish activity for that matter, not bearish as it is from May thereabout. I'll talk. It's a variety. It's a variety of issues. Number one, if by God's grace, let me use the word God's grace, we have the rate cap repealed or modified for that matter, we should expect some activity, because all of a sudden bank stock gets attractive, because the multiples right now look very attractive if a modification of the rate cap happens. What else? Because that will have an impact on private sector credit growth. Credit growth happens, we will already start seeing a lot of capex in capital expenditure in companies, better margins, better profits. So I'll say for a trigger factor, it's a modification of the rate cap. That could be a very good inducement to a bullish market going forward, yes.
Let's look at KCB, which was the leading performer of the top movers last week. It closed at 38.95. The upturn in prices, according to your weekly market wrap, is that it could be an indication of a possible shift, of course, from the bearish sentiment in the market. But we're also seeing KCB and a number of the other banks taking quite a lead role in fintech. And there's so much happening within the mobile space, mobile lending space, and KCB has done very well with KCB M-Pesa. How do you see that impacting that stock, and then perhaps the company and as a trickle down the stock itself?
Okay, all banks. We noticed that banks started taking after the introduction of the rate cap. One of the key elements banks started focusing on is on the non-funded income, because the funded income is where they're getting their big margins. I get your deposits from your 1GCO at 2%, 3%, lend at 15%, 16%. Big margins, hence good profits. I won't say supernormal profits like what journalists talk about. I'll say good profits. So right now with the shift, with the margins now compressed, because now you can only lend as much as 4% above CBR and deposit rate at technically not flow of 70% of the CBR. Banks now are shifting towards the non-funded income space. And the best way to capture the non-funded income space is through your digital lending. Because on digital lending, you have two forms of income you're targeting. You're targeting the interest income, which is actually revolving. It's 1 month, and then they're adding a fee component on it. So you'll find that technically your annual, what you call your annual percentage rate, with the normal loan is around, it's 13%, but with your annualized percentage rate on the digital loans, you're talking about 80, 90%.
Because most of them are at about 3.5%
yes,
per month.
Yes.
So if you annualize it, it's ridiculous.
M-Shwari 7.5% per month. So if you annualize that, give you north of 70, 80, 90%. I haven't done the math. Look at Fuliza. Fuliza is another expensive product. Look at which is the other one. Mostly, technically, you get the drift. Banks are targeting when even Barclays went with Timiza right now.
Yes.
So Timiza right now, they're charging a fee and charging an interest. Interest, you'll still peg it around 13%, but the catch here is on the fee income, because of the fee income now comes to your unfunded income, and that helps your buttress your top line. Yes.
So how do you see the banking stocks looking then, or the banks generally, the performance, given what you've just talked about in terms of the non-funded income side and what they are bringing to the table?
What's my view? I am actually I'm a banking analyst, and I'm bearish on banks at the moment.
Even with the mobile lending space?
Yes.
Why?
Because last year, one of the key component investors, keen investors took note of, and we analysts took note of, was in as much as the interest rate, the recorded bottom line was like, oh, profits are up 20%, profits are up 15, 11%. What you call the operating profit, that is before you take into consideration impairment costs on loans, was flat, even actually dipping. That shows you that in as much as they're growing the non-funded income space, it's not enough to cover the cost base as it is right now. So it's all about how do you increase efficiency. You have to reduce your cost to income ratio, increase your non-funded income in as much as your funded income is compressed. Yeah. And then the funded income now is compressed because of the yields on government bonds. You notice now governments have started actually, this year you'll notice that the government is actually pushing down the cost of borrowing for them, that is. So that's why I'm all bearish about banks.
Banks.
It's specific banks that are actually thinking outside the box. I'll talk for your Stanbic Bank, whereby you'll notice that your ratio of funded to non-funded is 55-45. That will actually be your banks to look out for in future. The rest of the banks are trying to catch up to those ratios. Yes.
Oh, interesting. Let's look at Safaricom, which maintained also the top mover position, accounting for 42.1% of total turnover last week. And Safaricom is in the news. Almost Safaricom has always been in the news. This time,
it's 45% of the market. Actually, north of 45%.
North of 45% of the market. So Bob Collymore announced that he will stay on for another year. Definitely, that came as good news. And there's just the news that came out today that the telco would buy out the M-Pesa IP rights for about 1.3 billion shillings. How do you see this impacting the performance of Safaricom? It's
a positive. In our view, it's a big positive, because once they buy the IP rights, now the 5% royalty fee they pay to Vodafone, it's cut off.
Cut off
okay?
completely, yeah.
So that will have an impact.
That's 5% annually.
On revenue.
Wow.
Spec on revenue. Exactly. It's quite, yeah. So that's buying the IP. It's a big plus, because now actually gives them leeway on where to expand into the regional market. They've actually, when Vodafone made its divestiture from Safaricom by acquiring Vodacom, which now owns part and parcel of majority shareholder of Safaricom, that is. The goal was now to make sure that Safaricom can comfortably go regional. And management of Safaricom has been very clear. We are not going regional to open your telecom services. We are only going there for financial services. So partnering with our telco, partnering with our bank, and then take the M-Pesa product global or regional, that is, for that matter. And I think that is a big positive, no doubt. Yes.
All right. Year to date, Safaricom and AABL were among the top gainers, while BAT was among the top losers. What stocks are you looking at as we kick off the week?
Safaricom, you can never fail not to check Safaricom. AABL, interesting, because we've noticed bullish sentiments from foreigners. Yet,
what is driving that?
That's a puzzle trying to figure out, because first of all, AABL is coming off last year with some pretty multi-year lows, so we can call it a rebound on that. Their first half numbers were really good. Second half will be good, but second half, which now their full year ends in June, so with their release in July, we think they'll be good. But now the challenge for AABL will be now on their December earnings. That is the first half of FY20 earnings. Because now if what is currently being projected with the drought, that will have an impact on what you call the value segment. The value segment is your Senator Keg, your Balozis and the like. That value segment gets hit whenever the disposable income or whenever the inflation pressures tick up, because just a 5 shilling margin increase, that hits that value segment. All right, let's quickly look at
Emakiba, which was reopened today in Machakos. Of course, sentiments from different quarters are quite mixed. And because, of course, the purpose for floating the Emakiba bond is to finance government development expenditure as well as budgetary support. But it has, for many people, fallen way below what it ideally should. And I'm just curious, as an analyst, a return of 10%, with as little as 3,000 shillings, do you think this is something Kenyans would really take up on if they really get to understand what it's about?
I think that's a good question. I think that the various way to look at it, on the return perspective, fantastic investment, 3%, 10% interest. Right now with a reopen, that would be a 15-year tenure, give or take, because it's a reopened paper. The question now becomes on why the low subscription. They just reopened it in early this year, got 79% subscription rate. Technically, we were expecting, earlier on it was being floated out, we were expecting like, oh my, now cash is moving from banks, now all of a sudden now everybody will invest in this the treasury bond. But no, the challenge is on the tenure, because you're looking at Kenyans who are by how am I able to lock in my money for 5, 10, 3 years or 15 months right now. So the question is, the tenure had a role to play. Secondly, there's the issue about user education. How many masses know about the Emakiba? So I think more how can I call it? More education, for lack of a better word, is required to go ahead and make sure that the product update is taken up. And thirdly is to make sure that investors, that is your locals, are told that you don't actually need to hold it, you can still sell it. But as you sell it, of course, there's a cost element. So you'll lose a couple of coins as you sell your bond. Yes.
Well, that's interesting, because I was just reading that the Emakiba bond has about, I think, 460,000 CDS accounts, out of a population of 40 billion, maybe 6 million of that being active, in the financial markets. That really says a lot about how the penetration of Emakiba is. Anyway, as we wind up, MPC, the Monetary Policy Committee, held their meeting today, maintained the base lending rate at 9%. Was that your expectations, and what do you see going forward?
Yes, that is our expectation, because currently, first of all, the MPC, the monetary policy was curtailed, for lack of a better word, curtailed in terms of its functionality with the rate cap, with the interest rate cap law, because now it's all pegged down to the cost of borrowing, going forward, they will check. We were of the view that they will have to be checking about the inflation pressures. Last month jumped 6.6%. Crude oil going up, that will have an effect. But right now it's a bit cooling off. But it's still north of your $70 a barrel. Will the drought, will the food inflationary pressures come in? I like in their statement today they've said a keyword was how fast the food maize is released from the strategic grain reserve. That is so important, because the moment if we allow grain not to be timely release of food from the strategic grain reserve, it will have an impact on the food inflation. That will actually have an impact on how MPC views it going forward. But with the rate tied to cost of loans, I still think going forward flat 9%, unless something drastic happens.
Well, thank you so much. We've been speaking with Martin Kirimi. He's a Senior Associate Research at the Standard Investment Bank, giving us a look at what happened in the markets last week, as well as a forward-looking view of what to expect in Kenya's and global markets this coming week. Well, on that note, we come to the end of our show. You've been watching Markets Today on Metropol TV. Remember to join Ali Khan Sachu at 8 o'clock on The Smart Investor, where he will be interviewing George Bodo, of course, on the issues around the Monetary Policy Committee meeting that was held today, where they held their base lending rate at 9%. My name is Terryanne Chebet. We'll now leave you with the prices of the agro-commodities today. you.